Barry Knapp is here around the table, called the table, with us. He's Ironsides Macroeconomics managing partner. And Joe made a reference to this earlier, Barry, welcome, that sometimes it takes a day. So is it a delayed kind of settling in of reality, or do you think the new facts, the targeting of the Gulf, what's going on with oil prices, are those enough to kind of go from sort of shrugging this off yesterday afternoon to now being down significantly again?
To be sure, Europe and Asia have a much bigger problem with energy than we do, and you could see that. Korean equities, Japanese equities got absolutely hammered last night. Japanese autos, in particular, led the weakness in the Nikkei, and they're all short energy.
Exactly.
It's sort of a key thing. I responded to one of Sarah's tweets last night about the dollar being a safe haven. I said, well, the real issue is the dollar is now a petrocurrency. Right? So we were short energy, the biggest energy importers until the shale boom a decade ago. And so there used to be this decided negative correlation between the dollar and oil. And it acted as a little bit of a check for everyone else in the world. The dollar would go down when oil prices went up. That's no longer the case. Dollar goes up and oil prices go up. So that exacerbates the problem for the big oil importers. Because oil is priced in dollars. So the dollar's going up at the same time the price of oil or nat gas is going up, then that makes the cost even more prohibitive for Japan, for Korea, for all of Europe. And so when you see the spike in gas oil prices and natural gas prices in Europe, they have a big problem.
When the dollar and oil go up together now, why is that? In other words,
because we're actually the biggest exporter of oil in the world. So much like the Canadian dollar used to go up when oil prices went up, or the Norwegian krona went up when oil prices went up because they're long energy. That's what flipped the correlation.
And look, we're up $1 again today. We're at 99 on the dollar, and this thing's moving around like a yo-yo. And so when that happens, is that also just putting pressure across the global markets?
Well, it is for Asia and Europe. It shouldn't be as big a problem for us, but it's a problem. It's a problem in as much as we already had this K-shaped economy. And you and I have talked about this numerous times about how the Fed eased primarily using their balance sheet and then tightened primarily using rate policy. So that left a situation where policy is at least 50 basis points too tight for small banks, small businesses, households that don't own assets, and at least 50 basis points, 50 to 75, too loose for long-term fixed-rate borrowers. So that's the whole K-shaped economy that the Fed's caused. The reaction to a spike in energy prices should actually be to cut rates, not ease rates. This isn't an inflation problem. I've heard it described as that. This is a supply shock. Well, a supply shock when government spending growth has slowed from 11 to 2 and money supply growth is well below its long-term median is actually going to hurt demand way more than it's going to cause an inflationary spiral. And if you think about that demand story, this is what I wrote about last week. There's a big resetting in this idea that growth is going to run hot. When you look at actually consumption of goods, during the course of 25, they slowed from 5% growth to 0. Services consumption went from 3.5 to 1.7. So we did have a decided slowdown in consumption, notwithstanding all the GDP numbers, which are distorted by trade, front running and all. So you already had a slowdown. And then if you do have a significant sustainable increase in gasoline prices, electricity prices, then you get more of a slowdown. So this is far more of just like the tariffs were, it's far more of a disinflationary shock than it is an potential cause for inflation. And again, that's what.
Well, what's your worldview? I mean, it's going to be. Are there tailwinds for the economy?
No, he's a rate cutter.
Yeah, there definitely are. But part of my scenario that we were going to have stronger growth this year, driven by capital investment, included the Fed cutting another 50 basis points to create a steep enough yield curve for small banks so they can start lending again. Lend to small real estate developers, for example.
And you don't expect that now? Or
I do expect it.
How about Warsh?
Well, Warsh is all in on this. So the Warsh-Besant plan is so spot on. And it's that the idea is first you have to steepen the yield curve. You need to cut to at least 3. Then you need to implement Bowman's bank deregulatory plan. And she's been spelling that out decidedly. And then you can start shrinking that $3 trillion of reserves that just sit on bank balance sheets or sit on the Fed's balance sheet actually and don't do anything. You can start reducing that, pushing that money out into the economy. But there's real resistance at the Fed. Any of the Biden appointees, Barr, presumably Jefferson and Cook, are against this. And then there's a group of regional vice presidents that are dead set against this, too.
Do you buy the whole privatizing the economy?
100%.
You do? Because when we get a bad jobs number, it's like a lot of government jobs are disappearing. Is that good? Is that bad? How many private sector jobs did Biden add versus government? I mean, there were a lot of government jobs coming during the Biden.
Oh, government. So this was wild, I thought. Government job growth was running 1% higher than private sector job growth, and government wage growth was running 1% higher.
Who pays that? Do private sector jobs pay the government jobs?
Well,
one private sector job is better probably than a. You need 10 of them to pay them.
It's sort of obvious from a productivity perspective.
I know, but not,
right?
It's not obvious to an entire half of the country.
Okay, Joe, but I don't know. I always tell people, go to the Department of Motor Vehicles and then tell me the government's more efficient, right? Like, you probably have to go to Springfield like I used to have to go to.
Yeah, there's a new one that they're trying. You can make an appointment. I've run into some people that sort of feel your pain.
When I go to Avon by Beaver Creek,
yeah,
it's done in 30 seconds.
You had Edwards, Colorado, my friend, the great skier, the new one, Breezy, right? Was Breezy?
No, Breezy's from Jackson. Michaela's from Edwards.
Michaela,
right?
Came back, which is that's like 5 minutes from your house.
Lindsay's dad's my next door neighbor, actually.
You're kidding.
She's back in Park City.
All right, they say we got to go.
Can I sneak in a wonky thing before you go real quick? Because I'm on board with everything you say. But then why is the 10-year at 4.1? Shouldn't it be lower than that if what you're saying is that this is a deflationary shock?
The reaction in 10s are curious because the move is being completely driven by real rates. And it's not being driven by the inflation component, inflation break-evens. So I would assume that's some idea that, well, maybe foreigners will have to sell to pay their gas bills or something goofy like that. But it had a big move in through last week, which was pointing to this disappointing growth outlook. So now you've got a retracement of that. But I doubt very much if 10s will keep going up because this is a hit to growth. And so I think you've just got some flow issues.
Sell to pay the gas bill. That's interesting. I know you're not saying that crazier things have happened.
Yeah, I mean, global flows, but global flows are a big issue because if we are successful in shrinking our trade deficit, as I expect we will be, like Nixon was in the 70s, Nixon and then so on and so forth. Anyway, that will reduce demand for treasuries over time.
Yes.
And that's sort of this underlying issue that no one's talking about. They're focused on trade, but not capital flows. And the capital flows are going to be massively impacted by this whole reordering of global trade.
Great point.
Yeah.